Co-owning a luxury vacation home is no longer reserved for the ultra-wealthy. Thanks to new platforms and financing models, it's now possible to own a slice of $1 million property with flexible payment options. But how do you finance a share in a luxury co-owned home, especially when traditional lenders aren't always familiar with the model? Here's how buyers are creatively and smartly financing their share of the dream. Number 1. Cash payment. Simple, but not always feasible. Many buyers still choose to pay cash up front, especially if the co-ownership share is relatively affordable, say $200,000 to $500,000. It's fast, eliminates debt, and avoids interest charges. However, not everyone wants to tie up that much capital in a second home. They'll use only part-time. For buyers who prefer leverage or want to keep liquidity, other financing methods come into play. Number 2, co-ownership financing through the platform. Some luxury co-ownership platforms now offer in-house financing or partner with lenders that understand fractional ownership models. For example, Picasso partners with lenders to offer financing for qualified buyers. Ember has a buy now, pay monthly model, which includes structured payment plans with fixed terms. These loans are typically designed for fractional purchases and structured through LLCs that hold the property title. The financing is attached to your ownership share, not the entire home. Tip: expect to put down at least 20 to 30% and provide income and asset verification, just like with a traditional mortgage. Number 3. Home equity loan or HELOC. If you already own a primary residence, you can tap into your home's equity to fund your share of a vacation home. Options include home equity loan, lump sum payment with fixed interest, HELOC, home equity line of credit, revolving credit that lets you draw as needed. This option can offer lower interest rates than unsecured loans and gives you more control over how you finance your share. However, it does put your primary residence at risk, so proceed cautiously. Number 4. Personal loans or unsecured financing. Some buyers opt for personal loans to finance their share. These loans don't require collateral, and approval is typically based on credit score and income. Pros: fast approval, no lien on property, ideal for smaller share amounts. Cons: higher interest rates, shorter repayment terms, not ideal for large purchases above $100,000. Number 5. Group buying with family or friends. If you don't want to go through a platform, consider private co-ownership with trusted family members or friends. In that case, you can pool resources, each contributing a portion of the down payment or taking loans individually. This requires a strong legal agreement outlining usage schedule, expense sharing, exit strategy, what happens in case of default. Number 6. Consider tax implications. While the IRS doesn't offer mortgage deductions for fractional shares the same way it does for full homes, you may still be eligible for some deductions depending on ownership structure, financing method, and property use. Always consult a tax advisor who is knowledgeable about real estate before committing to a financing method. Financing a share in a luxury vacation home is more achievable than ever, thanks to evolving lending models and flexible ownership structures. Whether you pay in cash, leverage your home equity, or finance through the co-ownership platform, the key is to choose a plan that matches your financial goals and protects your peace of mind. If you found this video helpful, hit like and subscribe for more luxury travel and co-ownership insights.